Hello, mortgage fans. So, welcome to our market update for the month of February, and what a month it's been. If you cast your mind back to the start of the month, we had Prince Andrew paying a lot of money to someone he's never met for something he never did, which sounds completely fine. COVID restrictions ended, which in any normal set of circumstances would be the big news, but on the very same day, Russia invaded Ukraine. So while the year started really well, we had January full of optimism, market conditions were good, we were really busy. Oh my Putin, how that all changed. And it's quite shocking, particularly in a sort of internet social media age, how you can follow these things live. I mean, I personally find it really quite macabre. So I sort of try and avoid it. I mean, you can't avoid what's happening. Sort of, you can't be ignorant equally, but I sort of tend to avoid sort of the real sort of disaster stuff that follows around it. But probably one of the few positives that have come out of this is that the Ukrainian people are clearly a Spartan race. Anyone who's followed stuff online, you've got all the top sports stars, models, prime ministers, all bearing arms and going to the front line. So, although it's quite a dark thing, it's actually quite amazing to see people being so proud of their country. And I'd wish that many other leaders followed with such integrity. But there we are. All I sort of hope is that this concludes very quickly. There's minimal loss of life, and the West, in brackets, can do all we can to support them, because we really, really should. But anyway, to pull this back to the mortgage and property market, which is obviously what we focus on, you can't ignore those impacts, and that they will have a small part to play. So I'm going to talk about that in a bit more detail and how it's likely to play out. So the very first question I would think is, what impact will the conflict in Ukraine have on the mortgage market? Now, the reality is very small. I think for 99% of people, you're not going to notice anything. UK banks are extremely well capitalised. Funding links to Russia aren't great, so we're not really going to see too much direct impact in the UK. Wholesale money markets will be affected. If you've been following this closely, you'll know that the UK government was actually leading the charge of removing the SWIFT system of stopping money coming into Russia, or certainly making it more difficult. So that will have a knock-on impact into wholesale money markets, but mortgage funding doesn't really work that way. Mortgage funding is quite slow. Banks tend to buy in money in huge tranches to sort of mitigate any sort of exposure to this sort of thing. So we're not really expecting anything. If things do procrastinate or draw on or get worse, then you might see the more niche areas of the market be affected. So this is typically people with very severe adverse credit, some buy-to-let funders, development finance, those sorts of areas that are very sort of niche. Because they're reliant on those wholesale markets, you might see that those lenders pull back a bit. And what that normally means is you have to put down slightly higher deposits, or interest rates rise is what you might see. But on a practical aspect, just 6 of the UK high street banks make up 85% of all lending. So that's probably pretty much everyone listening to this. So the expectation is they won't be affected at all. So that's what we're expecting. The second big point I would suspect would be, will there be an impact on the UK property market? So again, probably a bit more of a question mark on this one. I'd say in terms of the UK market, no. I think, again, 99% of people won't be impacted. However, what is very interesting is the financial sanctions that have gone on against high-profile Russians and Belarusians also. So you can't ignore that, because I think for a long time, London was described as Londongrad, which is a bit sort of tongue-in-cheek way of saying that there's a lot of Russian money in the UK, and specifically in London, and even more specifically, very certain areas of London. So that's sort of been a thing for a while. It's not to say it's illegitimate at all. There's very many completely legitimate people there. However, where this might get interesting is that the government, I actually watched Prime Minister's Questions last Wednesday, and the government are very, very clear. They're going to pursue a very aggressive line on what they call unexplained wealth orders. This gives them the remit to look into structures or individuals where they can't explain the source of wealth. Now, where this will be very specific to that end of the property market is a lot of properties, typically around Belgravia, Mayfair, all those Kensington, all those really sort of lovely parts of London, are often bought through structures. And how this works is a UK limited company will buy the property, but then the ultimate ownership is then based out of a trust or a structure in an offshore jurisdiction. And that's often then dependent on where the ultimate beneficial owner resides. So that's a quite complicated area we won't get into. But the UK government are very actively going after that. So probably the best way to sort of put this into layman's terms is, if you've been following this again, you'll see that Roman Abramovich is getting rid of Chelsea Football Club. And I can't remember the name now, but there's another billionaire who sort of offered the club, who very publicly called this out, I think, with the designs of bringing the price down. And that's what could happen here, is if there is a large sell-off of super prime property, because it's a very small market, you might see prices dip. However, for us mere mortals, we're not likely to see that because the entry point to that market is often £10 million plus. So if you're sort of a normal human being buying property probably up to 10 million, you're not likely to be impacted. In fact, quite the converse is true. There's been quite a few high-profile London estate agents saying they expect prices in the capital to go up between 8 to 10% this year. And that's driven by very high buyer registration. I believe it's something like 35% up on this time last year, and then lower than normal stock levels, which I believe could be anywhere down to 25% down on last year. So you don't have to be a genius to work out supply and demand there. So for normal mortals, I think we're going to look at prices in London actually go up for the first time sizably, really since 2016. So I don't think what's happening in the Ukraine or even that end of the market that I mentioned is not going to have an impact because it's so small. I suspect prices in London will be up anywhere up to 10% this year by the looks of things. And the last big question for us is, what does this look like for interest rates? Now, a normal market dynamic is when you ever get a big conflict is that stock markets go down and interest rates go up. There's lots of reasons for that, but in this particular time it holds true, particularly because with the stock markets, if war is just bad for business, supply lines are damaged, all sorts of issues that sit around that, to be a genius to work that one out. And interest rates go up, or the cost of borrowing goes up, because if it's perceived that it might be more difficult to raise funds in the future, or be less cash available or less profit, then people tend to hoard cash or lend it out as a premium. So that's the basic market dynamic. Specifically in the UK as well, Michael Saunders, who sits on the MPC, which is the policy committee of the Bank of England that sets interest rates, this week said that he expects the Bank of England to push on with rate rises as planned, and that's post-Russian invasion. So those comments are very much taken that we will expect to see interest rates in the UK to continue going up regardless. In fact, he specifically as an individual voted for a 0.5% rise last time out. So his views are very clear that we need to raise interest rates in the UK. That's because inflation is projected to go well over 7% this year. And there's lots of research to say actually real inflation is way higher than that. So the usual thing to do is to raise interest rates to bring spending down, bring costs down. Again, for all of the reasons we've mentioned, how much of an impact that will have is proven, or is yet to be proven. But that is certainly the trajectory for the year. So how that plays out into market rates, again, you won't be surprised to learn that all money market rates are up. And that then leads me into probably the single biggest thing that mortgage brokers are talking about right now. And if you're looking at getting your mortgage right now, this is your single biggest issue, is that banks are raising interest rates on their products irrespective of the Bank of England. So what they're doing is forward pricing rate rises. So in English, mortgage rates are going up even though the Bank of England haven't raised their rates yet, but they're expected to. So to put that into context, so in the last 4 weeks, in the last month, two-year money is up by 0.24% to 1.37. 5-year money is up 0.09 to 1.37%, and 3-month sterling LIBOR, which is probably the biggest mortgage funding line, is up 0.246% to 0.878. And the UK base rate also went up in February from 0.25 to 0.5. So every single indices of money is up. So that's why it's no surprise mortgage rates are going up. So the trajectory is pretty clear. We expect interest rates to go up by around about 1% in the next 12 months. So in our view, if you are looking at getting a mortgage and it fits with your life plans, we would suggest fixing for the longer term is probably going to be the best value for in the long term. So it does depend on your circumstances, but as a general rule, we think fixing for the longer term is probably the sensible thing to do. Now, how that breaks down specifically into mortgage rates. So obviously that's the money market rates, but then banks charge a premium on top. To give you an idea, the very best rates on the market as we sit today are 2-year fixed rates start at 1.55%, 5-year fixed rates start at 1.68%, and variable rates start from 0.79%. I have spoken about this previously, and please do look at a previous update, and you need to be very cautious on discount rates because they still haven't moved up from where the base rate was, so the real cost of that could well be a lot higher, so just be very careful with those. And buy-to-let starts at 1.09%. So that's where the money market rates are. That's what our expectations are also. Hopefully you found this update useful. The reason why we do this is for a very simple purpose. Our goal is to get your mortgage paid off as fast as possible. I've done this long enough to know that no one wants a mortgage. So our aims are to help you get that paid off as soon as possible. And hopefully by giving you this good information, we can read the market, do what's best for you, and ultimately save you the most money over time. So hope you found this useful and look to catch up with you soon.